Listen, I want you to picture something real, not a hypothetical, not a worksheet from a retirement seminar, a real American front porch. Coastal Georgia, a Thursday morning in January of 2026. His name is Raymond. He is 64 years old. He is sitting in a rocking chair with a cup of coffee going cold in his hand. He has been sitting there for 40 minutes. He is not watching the sunrise. He is staring at a number he wrote on the back of an envelope last night at the kitchen table. The number is 67. That is the age Raymond has been told, by his financial advisor, by his brother-in-law, by 3 different articles he bookmarked on his phone, that he should claim Social Security. Not 62, not 65, not 70, 67. Full retirement age. The responsible choice, the smart choice, the choice that every generic retirement calculator in America has been spitting out for the last decade. Raymond worked 41 years as a licensed electrician. Union job, hard hat, early mornings. His knees are shot. His lower back has been a problem since 2019. He has $340,000 in a traditional IRA. He has $28,000 in a savings account. He owns his house outright. $290,000 in a market that has been flat for 2 years. Raymond is ready to retire. Raymond is ready to claim. Raymond has done everything they told him to do. Raymond has never once been told about the number, not by his advisor, not by the Social Security Administration, not by the articles, not by the calculator. There is one number, a single threshold, that determines whether the IRS will tax 0%, 50%, or 85% of every Social Security check Raymond receives for the rest of his life. Raymond does not know what that number is. Raymond is about to claim Social Security without it, and the IRS is counting on exactly that. If you are watching this video and you are within 5 years of claiming Social Security, or if you are already claiming and nobody has ever walked you through this calculation, you need to stop everything right now. Because there is a number, a specific, calculable, legally defined income threshold that the IRS uses to determine how much of your Social Security benefit is taxable every single year for the rest of your life. Most retirees have never heard of it. Most financial advisors mention it once in a meeting and move on. And the Social Security Administration, the agency that sends you the check, does not subtract the tax before it hits your account. They send you the full amount and let the IRS collect on the back end. Quietly, annually, for decades. I am going to show you that number today. I am going to show you exactly how it is calculated. I am going to show you the 3 income sources that push you over it without you even realizing it. And I am going to show you the 4 moves that legally keep you under it, permanently. Because the difference between knowing this number and not knowing it is not a rounding error. For the average retiree with a traditional IRA and a pension, the difference is between paying tax on 0% of your Social Security and paying tax on 85% of it, every single year. For 20 years of retirement, that is not a tax bill. That is a 6-figure government extraction hiding inside the check you spent your entire career earning the right to receive. Before we go one word deeper into this, smash the like button right now. The Social Security Administration processes 10,000 new retirement claims every single day. The overwhelming majority of those claimants have never run this calculation. The agency is not going to run it for them. The agency sends the check and lets the IRS handle the rest. Everything in this video breaks the algorithmic suppression and puts this calculation in front of one more retiree before they walk into that SSA office. Subscribe, flip the bell, join the archive, and drop one word in the comments right now. Tell me, have you already claimed Social Security, or are you still deciding? Claimed or waiting? One word, drop it now, because your answer determines which part of this video is most urgent for you, and I want to know exactly who is in this room with me today. Now, the number. The number is called your provisional income. Write that down, provisional income, because this is the single most important calculation in your entire retirement tax picture, and it does not appear anywhere on your W-2, your 1099, or your standard tax return summary. The IRS invented it. The IRS uses it exclusively to determine how much of your Social Security benefit gets dragged into your taxable income. And the IRS has never once mailed you a letter explaining how it works. Here is the formula. It is not complicated, but it is devastating if you do not know it. Provisional income equals your adjusted gross income, not including Social Security, plus any tax-exempt municipal bond interest you receive, plus 50% of your annual Social Security benefit. Let me say that again slower. A GI minus Social Security, plus muni bond interest, plus half your Social Security check. That total is your provisional income. And here is what the IRS does with it. If your provisional income is below $25,000 as a single filer, or below $32,000 as a married couple filing jointly, 0% of your Social Security is taxable. 0. The check arrives, the IRS leaves it alone. If your provisional income is between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 as a married couple, up to 50% of your Social Security benefit becomes taxable ordinary income. If your provisional income exceeds $34,000 as a single filer or $44,000 as a married couple, up to 85% of your Social Security benefit is taxable. 85%. Not an 85% tax rate, 85% of the benefit included in your taxable income, then taxed at your marginal bracket. For a retiree in the 22% bracket collecting $28,000 a year in Social Security, that means $23,800 of that check is now taxable income. At 22%, that is a $5,236 annual tax bill on money the government already taxed when you earned it as payroll contributions. And here is the part that makes this a genuine mathematical crime. Those thresholds, $25,000 and $34,000 for single filers, $32,000 and $44,000 for married couples, were set by Congress in 1983 and 1993. They have never been adjusted for inflation, not once. In 1983, $25,000 was a meaningful income threshold. In 2026, $25,000 is below the poverty consideration for a retiree in most American cities. The IRS has never raised the bar, but Social Security cost of living adjustments have pushed millions of retirees over it every single year for 4 decades. This is not an accident. This is a stealth tax increase that requires 0 congressional vote because Congress simply refuses to index the thresholds to inflation. Every year that passes, more retirees cross the line. More Social Security gets taxed. More revenue flows to the Treasury, without a single senator casting a single vote. Now let me show you Raymond's math, because Raymond is about to walk into this trap at full speed. Raymond's Social Security benefit at age 67 will be approximately $2,650 a month. That is $31,800 a year. Raymond also has his traditional IRA. He is 67. He is not yet at RMD age. That is 73 under current law. But he needs income. So he plans to withdraw $24,000 a year from the IRA to cover living expenses. Raymond has no pension. He has $1,200 a year in interest from his savings account. Let us calculate his provisional income. AGI excluding Social Security. $24,000 IRA withdrawal plus $1,200 savings interest equals $25,200. Tax-exempt muni bond interest, 0. Raymond does not own muni bonds. 50% of Social Security. 50% of $31,800 equals $15,900. Provisional income, $25,200 plus $15,900 equals $41,100. Raymond is a single filer. The 85% threshold is $34,000. Raymond's provisional income of $41,100 blows past the 85% threshold by over $7,000. Result: 85% of Raymond's $31,800 Social Security benefit, $27,030, is included in his taxable income every single year. At Raymond's marginal bracket of 22%, that is a $5,946 annual tax bill on his Social Security alone. Over 20 years of retirement, assuming Raymond lives to 87, which is the average life expectancy for a 67-year-old American male in reasonable health, that is $118,920 in cumulative taxes paid on Social Security income. $118,000. Raymond thought he was claiming a retirement benefit. Raymond was actually signing up for a 20-year tax installment plan with the IRS, and nobody told him. Stop the video right now, pull out a piece of paper, write down these 3 numbers. Your expected annual Social Security benefit, your expected annual IRA or 401k withdrawals, any pension, interest, or dividend income you expect to receive. Add the IRA withdrawals, pension, interest, and dividends together. Then add 50% of your Social Security number to that total. That is your provisional income. Compare it to $34,000 if you are single, $44,000 if you are married. Are you over the line? Drop your number in the comments. Anonymized. No real names, no account numbers. Just the provisional income figure and whether you are single or married. We are going to map the exposure in this comment section together. I read every single one. Now let me walk you through the 3 income sources that silently push retirees over the provisional income threshold, without them ever realizing it. Because Raymond's situation is actually one of the cleaner versions of this trap. Most retirees have multiple income streams all firing at once, and each one adds to the provisional income calculation in ways that feel invisible until tax day. This is the biggest driver of provisional income inflation for the average American retiree. Every dollar you pull out of a traditional IRA or traditional 401k hits your AGI dollar for dollar. And your AGI is the foundation of the provisional income calculation. But here is the spiral that nobody maps out at the kitchen table. You need $30,000 to live on this year. You decide to pull $30,000 from the IRA. That $30,000 raises your AGI. The higher AGI raises your provisional income. The higher provisional income drags more of your Social Security into taxable income. The taxable Social Security raises your AGI further. You needed $30,000. To net $30,000 after the combined income tax on the IRA withdrawal and the newly taxable Social Security, you actually need to withdraw somewhere between $35,000 and $38,000, depending on your bracket. The additional withdrawal raises the AGI further, which raises the provisional income further, which taxes more Social Security. This is called the torpedo effect, the tax torpedo. Every dollar you pull from the traditional IRA detonates a secondary explosion in your Social Security taxation, and the torpedo gets worse every year as the IRA balance grows. Because even if you do not need the money, at age 73, the RMD rules force you to pull it out whether you want to or not. Raymond at age 73. His IRA has grown from $340,000 to approximately $510,000, assuming modest growth. His RMD at age 73 with a 26.5 divisor is approximately $19,245. He does not need that money. He is living fine on Social Security. But the IRS does not care what Raymond needs. The IRS forces the withdrawal. The forced withdrawal hits the AGI. The AGI inflation detonates the provisional income. The provisional income drags 85% of Raymond's Social Security into taxable income. Raymond is paying taxes on money he did not choose to take and did not choose to spend. That is the RMD torpedo, and it fires every January for the rest of his life. This is the trap that catches retirees who think they have a simple financial picture. Provisional income includes sources of income that feel invisible on a day-to-day basis, but show up on a 1099 every January with brutal clarity. CD interest, money market interest, savings account interest, treasury bond interest, taxable dividend distributions from mutual funds, capital gains distributions from funds you never sold, partnership income from limited partnerships, rental income net of expenses. Every single one of these hits your AGI. Every single one inflates your provisional income. Every single one pushes more Social Security into the taxable column. The retiree who has $200,000 in CDs at 4.5% is generating $9,000 a year in interest income. That $9,000 goes directly into the provisional income calculation. That $9,000 alone can be the difference between having 50% of Social Security taxed and having 85% taxed. And muni bond interest, which most advisors sell as tax-free income, is added back into the provisional income calculation explicitly by the IRS formula. Tax-free at the federal level, fully counted for provisional income purposes. Your advisor tells you muni bonds produce tax-free income. He is technically correct, and the IRS still uses that income to tax your Social Security. Both things are true simultaneously. That is not an accident. That is engineering. This is the one that turns a manageable problem into a permanent one. The age at which you claim Social Security determines your benefit amount for life. Claim at 62 and you receive approximately 70% of your full retirement age benefit permanently. Claim at 70 and you receive approximately 124% of your full retirement age benefit permanently. Most financial advisors focus exclusively on the break-even math. How long do you need to live for the delayed claiming strategy to pay off in gross benefit received? Nobody runs the tax math alongside the break-even math. Here is what that looks like for Raymond. If Raymond claims at 62, his benefit is approximately $1,855 a month, $22,260 a year. His provisional income with the same $24,000 IRA withdrawal is $24,000 plus $11,130, 50% of his Social Security, equals $35,130. He is over the 85% threshold, but not by much. His taxable Social Security is approximately $18,921. At 22%, that is a $4,162 annual tax bill. If Raymond claims at 70, his benefit is approximately $3,307 a month, $39,684 a year. His provisional income with the same IRA withdrawal is $24,000 plus $19,842, equals $43,842, deeply over the 85% threshold. His taxable Social Security is $33,731. At 22%, that is a $7,421 annual tax bill. The larger benefit at 70 generates a $3,259 higher annual tax bill than the smaller benefit at 62. The conventional wisdom says delay to 70 for the bigger check. The tax math says the bigger check is taxed more aggressively, and the net after-tax difference between claiming at 62 and claiming at 70 is far smaller than the gross benefit comparison suggests. This does not mean claiming early. It means you cannot make the claiming decision without running the provisional income calculation first. The claiming age multiplier means every year you delay, you are not just increasing your gross benefit. You are also increasing the portion of that benefit the IRS will tax. The two move together, and most retirees only see one of them. Let me name the villain. In 1983, the Greenspan Commission on Social Security Reform was facing a crisis. The Social Security Trust Fund was nearly insolvent. Congress needed revenue, fast. The Commission recommended, and Congress passed, a provision making up to 50% of Social Security benefits taxable for higher income recipients. The threshold was set at $25,000 for single filers and $32,000 for married couples. In 1993, the Clinton administration needed additional revenue to reduce the deficit. Congress raised the ceiling, making up to 85% of Social Security taxable for recipients above the second threshold. The second tier was set at $34,000 for single filers and $44,000 for married couples. Both sets of thresholds were fixed. No inflation indexing, no automatic adjustment, no COLA built in. The Joint Committee on Taxation knew in 1983 that fixed nominal thresholds would capture an increasing share of Social Security recipients every year as nominal incomes rose. They knew it. It was in the projections. It was in the actuarial tables. They passed it anyway. In 1983, approximately 10% of Social Security recipients paid any tax on their benefits. In 2026, the Social Security Administration's own trustees report estimated that more than 56% of Social Security recipients pay tax on their benefits. From 10% to 56%. Not because Congress voted to raise taxes on Social Security, because Congress voted once in 1983 and again in 1993, and then did nothing for the next 4 decades while inflation did the work for them. That is the design. That is the machine. That is the villain. A tax increase that requires no votes, no legislation, no accountability, just the passage of time and the mathematical certainty of inflation. Send this video to one person you know who is within 5 years of claiming Social Security. Not tomorrow, right now. Pull out your phone, hit share, send it. One conversation, started by you today, saves them potentially $5,000 a year in avoidable Social Security taxes for the rest of their retirement. Over 20 years, that is $100,000. That is a conversation worth having tonight after dinner. Send the video. Make the call. Now let us talk about the 4 moves that legally keep your provisional income under the threshold, or minimize the damage if you are already over it. This is the single most powerful provisional income management tool available to a pre-retirement American. Here is the mechanic. Every dollar you convert from a traditional IRA to a Roth IRA before you claim Social Security is a dollar that will never appear in your AGI again. Roth distributions are not counted in the provisional income formula. They are completely invisible to the calculation. So if Raymond converts $100,000 of his traditional IRA to Roth between age 60 and age 63, paying the conversion tax now at his current bracket, those dollars are gone from the provisional income calculation forever. When Raymond retires and starts withdrawing from the Roth instead of the traditional IRA, his AGI drops. His provisional income drops. The percentage of his Social Security that is taxable drops. The conversion costs money up front. The conversion saves money every single year for the rest of Raymond's life. Run the math across 20 years. The Roth conversion that costs $22,000 in income tax today saves Raymond approximately $5,000 per year in reduced Social Security taxation. Break even is 4.4 years. Every year after that is pure savings. The window to execute this is the gap between retirement and Social Security claiming, the years when wage income has stopped and the IRA has not yet started throwing off RMDs. That gap, typically age 60 to 67, is the lowest income window of most retirees' lives. It is the cheapest time to convert, and it is the window that closes the moment Social Security and RMDs start firing simultaneously. Not all income is created equal in the provisional income formula. Qualified dividends and long-term capital gains from a properly structured taxable brokerage account are included in your AGI, but they are taxed at preferential rates. For retirees in the 0% capital gains bracket, which in 2026 applies to taxable income below approximately $47,025 for single filers, qualified dividends and long-term capital gains generate zero federal income tax, but they still count in the provisional income formula. So the restructure is to shift income-generating assets from high AGI impact sources, CDs, money market funds, treasury bonds, taxable interest, to low AGI impact sources where possible, municipal bonds. The interest is tax-free at the federal level. It still counts in provisional income, but you eliminate the income tax on the interest itself. The net cost of holding the muni bond is lower, even though the provisional income impact is the same. I-bonds and Series EE savings bonds. Interest accrues, but is not reportable until redemption. You control the year you take the income hit. Fixed indexed annuities and multi-year guaranteed annuities. Growth inside the annuity wrapper is tax deferred. It does not appear on a 1099. It does not hit your AGI. It does not affect your provisional income until you take a distribution, and you choose when that happens. Restructuring the income-generating layer of the portfolio from taxable interest to deferred or tax-advantaged income sources can reduce annual provisional income by $5,000 to $15,000 without reducing the actual cash flow available to the retiree. This is not about whether to claim early or late in isolation. This is about sequencing the income streams to minimize the years of maximum provisional income exposure. The most dangerous provisional income window for most retirees is the first 5 years of retirement, when they are drawing heavily from the traditional IRA to bridge the gap before claiming Social Security, and when the IRA withdrawals are largest relative to total income. The strategic sequence looks like this. Retire. Live on a combination of Roth distributions, which do not count in provisional income, and small, carefully calibrated traditional IRA withdrawals designed to stay under the 85% threshold. Use this window to execute Roth conversions aggressively. Claim Social Security at the age where the net after-tax benefit, not the gross benefit, is maximized given your specific provisional income projection. For some retirees, that is 62. For others, 67. For very few retirees with low AGI and large Roth balances, it is 70. The answer is different for every financial picture. The calculation is the same for everyone, and virtually no one is running it before they walk into the SSA office. This is the one you do starting today, regardless of everything else. Every October, before the year closes, sit down and project your provisional income for the current year. Add up your expected AGI excluding Social Security. Add any muni bond interest. Add 50% of your annual Social Security benefit. Compare that total to the thresholds. $34,000 single, $44,000 married. If you are approaching the line, throttle back, delay a Roth conversion, defer a capital gain, reduce an IRA withdrawal, push income into January of next year. If you are already deeply over the line, the optimization conversation shifts to long-term restructuring, Roth conversion ladder, income source restructure, annuity wrapper strategy. But you cannot make any of these decisions if you do not know your provisional income number. That number is the one Raymond did not have sitting on his front porch in Georgia. That number is the one the SSA does not calculate for you. That number is the one your generic financial advisor has probably never shown you on a spreadsheet. Know your number. Run it in October. Run it every October for the rest of your retirement. Here is the final warning. The provisional income thresholds are not going to be raised by Congress anytime soon. There is no political will to reduce Social Security tax revenue. Every year that passes, more retirees cross the line, more Social Security gets taxed, more revenue flows to the Treasury. The SSA will not calculate this for you. The agency that sends the check has no obligation to tell you how much of it the IRS will take back. Your broker will not calculate this for you unless you specifically ask. And even then, most brokers are not running the full provisional income model with the IRMAA interaction, the RMD torpedo, and the claiming age multiplier all layered together. You have to know this number before you claim it, because the moment you claim, the moment you lock in your benefit amount and your income structure, the die is cast. You can restructure around it. You can convert Roth dollars. You can shift income sources, but you cannot unclaim Social Security. You cannot go back to the SSA office and say you did not know about the provisional income threshold. Raymond is sitting on that front porch right now. He is holding a cold cup of coffee and an envelope with the number 67 written on it. He does not have to walk into that SSA office blind, and neither do you. If this video opened your eyes, if any single number I showed you today landed differently than you expected, do 3 things before you close this app. Like the video. It breaks the shadow ban. It puts this provisional income calculation in front of one more retiree before they claim. Subscribe and flip the bell. The next video breaks down the exact RMD torpedo calculation, the year-by-year math showing how forced IRA withdrawals compound the Social Security tax problem after age 73, with the exact bracket interaction mapped out for 2026. Comment right now. Tell me your age, whether you have claimed yet, and roughly what your traditional IRA balance is. The comment section is the field hospital. Drop your field report. We build the analysis together. And go to retireeshieldreport.com. Take the free assessment. Get your provisional income snapshot calculated for your specific numbers, your state, your accounts, your benefit estimate. See exactly where you stand before you walk into that SSA office. Raymond deserved to know this number before he claimed. You deserve to know it too. Stay sharp, stay angry, and for the love of everything, run the provisional income calculation before you make the call. I will see you in the next one.